Hi there, Pragati here. Today I want to share with you all the different kinds of mortgages and the things that you should consider when you're going into these mortgages. A lot of the homeowners, they are on residential mortgage. Okay, so this is where you're paying your interest and capital. In another word, it's also called the repayment mortgage. Okay, so that's how you start up. But when you move into the next property, second property or another property, these are classified as buy-to-let mortgage because you're buying a property on a mortgage, but that property is going to be let out, it'll be rented out. So it's called buy-to-let mortgage. So generally with the deposit, so you got the deposit part, and then you got the loan part, which comes from the lender or the bank. With the residential mortgage, your first home mortgage, the deposit could be as little as 5%, generally 10%. You can have more deposit, but 5 to 10% seems to be the norm because the first time buyers, they wouldn't have so much money, and 5 to 10% is what seems to be happening in the market. But with the buy-to-let mortgages, a minimum requirement is mostly 25%. Although there are some lenders who will consider 20%, generally it's 25%. Okay, so think about that. So with the buy-to-let mortgage, you got a higher deposit. Okay, so not just 10%, but you would be required to put in about 25% deposit into the mortgage. And the next thing you want to think about is whether you want interest only or a repayment mortgage. Okay, so the interest only payment is where you're only paying the interest, so you're not paying anything towards the principal or the capital. Okay, so interest only. And the other one, which is just like your own residential property, is your interest and capital. Okay, so obviously the interest only payment will be less monthly payment, because you're not putting anything towards the capital. Now this is good for cash flow because you're not paying too much money to the bank, so you're only paying a small amount, the interest amount only, and you're getting more money, cash flow, into your pocket. So think about that. And generally buy-to-let mortgages are always interest only because that's how it makes sense. Otherwise, it's not really business worthy. It doesn't make any business sense. Okay, so the next thing you want to think about is whether you want a fixed mortgage, fixed interest rate, or whether you want a tracker interest rate. A fixed, the interest rate is, you would fix that certain interest rate for a certain period of time. So generally it's 2 years minimum. It could be 2 years, 3 years, 5 years, 10 years. So the longer the period, the higher the interest rate, because you don't know how the future economy is going to be, and generally the interest rate probably will be going up. So if you lock your interest rate for a longer period, then it'll be slightly higher rate as well. But overall, in a long-term 10-year period, you might still be benefiting out of that. And the other one is the tracker rate, where the rate will track the Bank of England base rate. So as the rate fluctuates, it could be, there was a month where just after the 2008 recession, there was a month where the interest rate changed 5 times in 1 year. So think about if, so the interest rate actually went from 1 point something into nearly 4% in such a short period of time. So if you were on a tracker rate, and let's say you were on a 1.5% now, but then if the interest rate was changing 5 times in a year with an increment of 0.5% every time it changed, you'd be soon into a 3%. So you really need to understand the financial market and the economy before you get into the tracker rate. On a stable market, maybe it's worth it, but me personally, if the economy is still recovering and it's not stable, then I think it's best just to get into a fixed rate. Like a lot of mortgages now, people are fixing for 5 years because the interest rate is so low. If it's so low, the only way you can go is up. So you need to think about your plan. If you was thinking to remortgage or trying to pull out some money, in 2 years' time, don't fix it for too long, because after 2 years you can remortgage and maybe pull out some money and use it for somewhere else. So just think about like your plan on how you planning to utilize your assets before you just fix it for a long term. Because if you pay remortgage early, or if you pay the mortgages early, there's early repayment charges as well, so which could be, you know, certain percentage of your total value of the property, and you could lose out. So just think about that as well. So you got the fixed rate and the tracker rate, okay? And the next one, like I said earlier, is the period of time. So the fixed rate comes with fixed for how long, whereas the tracker rate, it just goes into a tracker rate until you change into a fixed rate, okay? So that, and then you got the other rate called the bank standard variable rate, it's called. So that is when, let's say you finished your 2-year term on that particular interest rate, and if you did not renew that, then the rate's going to go into the bank's variable rate, which is pretty high actually. In the current market, it's about 4.75, I think, you know. So you could have been having a mortgage at, you know, 1.8%, and the 2-year term's finished, and if you didn't do anything with that, the rate's going to go up to 4.75, just for an example, but it is pretty high. Okay, so these that's another thing that you want to consider. The next thing you want to consider is the fee. There's always a product fee. It's also called administration fee or a product fee, which could range anywhere from £500 to £2,000. So if you add, if you're paying the product fee upfront now, then your interest rate will stay the same. Your monthly payment will stay the same. But then, you know, a lot of lenders will allow you to add the product fee into the mortgage. So basically the mortgage is going to be slightly higher, which means your monthly payment will be also slightly higher. It could be, you know, it could increase by £5 to £10 per month by adding that product fee into the mortgage, depending on how much that product fee was. If it was £2,000, probably yes. If it was only £500, maybe it's worth just paying off that £500 because it is not a big amount. There are some products which do come with no administration fee or no product fee, in which case the interest rate will be again slightly higher. So with a zero product fee, but the interest rate is slightly higher. Because it all depends on how much money you can spare at that particular time of your life. You know, if you got a lot of cash sitting around, you might as well pay that the product fee and have a slightly lower monthly payment. Or if you are cash tight, then just add product fee into the mortgage, and so you don't have to take that £2,000 out of pocket right now. So these are some of the things that you would need to consider when getting into a mortgage, right? So that you can make an informed decision, so that you can make the right decision for the business or the partner. So just to summarize, the things that you will need to consider is the type of the mortgage, whether it's a repayment or interest only. Most of the time it's interest only for a buy-to-let. And then whether it's a fixed term or a tracker, the length of term fixed that you're looking at, 2 years, 3 years, 5 years, 10 years, and whether you're going to add the product fee or you're not going to have any product fee but have a higher interest rate instead. Thanks for watching. If you like my video, please like and subscribe.